Like, please, if you're going to get one thing out of this video, I cannot understate how important this is to Amazon's entire story. Amazon has incredible customers. Welcome back. I don't waste your time. Let's get straight into it. Today, we're going to be looking at why I think Amazon is the single most neglected, single most undervalued tech stock. As always, we're going to be looking at the business operations first. So what the company does to earn money. Then we're going to be looking at the fundamentals of the company, the PE, the free cash flow yield, all that great stuff, return on capital employed. Then we're going to be looking at the risk factors of the company. So what can possibly go wrong to materially affect the company. After that, we're going to be looking at the economic moat of the company. So what can the company do to negate the risk factors and protect its moat, as Buffett likes to put it, and ensure that there is long-term value creation. And then at the end of it, I'm a big believer of Terry Smith and his very simple 3-step strategy of identify good companies, which by the end of it, hopefully we identify Amazon as being one. And then step number 2 is try not to overpay. So number 5, we're going to be looking at the entry points of the company, where you could possibly buy in, because we don't necessarily want to overpay. Anyways, with that being said, the business operations of the company. First of all, I think everyone is very familiar with Amazon's big product, their e-commerce. So you go onto Amazon.com and you type in literally anything, and you're able to buy that online, and it'll show up at your door a few days later or the same day if you're living in some metropolitan cities or whatever. The e-commerce, I don't necessarily care too much about it. It drives growth into the other segments of the business, so that's kind of the important thing to note with that. It's not profitable. And it's just a very boring portion of Amazon. There is this thing called the flywheel effect, where I'll try to explain it as simply as possible without butchering it. But basically, Amazon has cheap prices. The cheap prices attracts customers, and the more customers it attracts, it allows Amazon to make cheaper products. And because Amazon makes cheaper products, it allows more customers to come. So it's just a perpetual circle or flywheel that customers flock to Amazon. Amazon causes cheaper prices attracts more customers. It's just perpetually doing that. And Nick Sleep, a super investor, which I'd recommend you looking into, he's identified this with Costco and Amazon in the early 2000s, and it's a very powerful effect which drives long-term value creation. Final thing, cool thing to note, Amazon accounts for 40% of US retail e-commerce. This essentially means 2 of every $5 spent online is Amazon. Another cool thing to note with that, the next 14 biggest online retailers make up about 31%. So Amazon alone is bigger than the next 14 on the list, and then 30% is everybody else. Something cool to note, a little bit of a monopoly there. So actually, when we get to the risk factors, this could be a point of regulation risk. That is something to know. Next up, Prime. Prime has 90% plus retention rate. Prime is essentially just pure profit for Amazon. They don't really have to do anything for that monthly subscription of $10 to continue to kick in. Amazon, as we'll see, the farther we go down, has a lot of levers to pull to create profit, So for example, they have about 200 something million members worldwide. This number is from 2021. I couldn't figure out another number, so I just said greater than 200 million. But anyways, they have about 200 million members worldwide. If we assume I don't know how much Amazon's subscription is at the moment. Anyways, if we assume a $10 per month subscription worldwide, and if Amazon were to increase that $1 a month extra, that means they've created 12 times 200, so about 2.4 billion out of thin air, which is just pure profit. Again, Amazon has these levers they can pull to just create net income out of nowhere. Third-party sellers. This is a little bit lesser known, but when you go on Amazon.com, sometimes it's Amazon selling you the products. Like Amazon went and bought Sour Patch Kids candy from the company that makes Sour Patch Kids. I don't know what company makes Sour Patch Kids. Anyways, they bought candies and they just store it in one of their fulfillment centers, or it's like a clothing brand, or it's someone that bought stuff and they're trying to sell it on Amazon and they send it. It's FBA, fulfillment by Amazon, right? So third-party sellers, basically you can send your stuff that you want to sell on Amazon to Amazon. They store it in a fulfillment center, and then whenever someone goes to Whenever someone goes on Amazon to buy something and they buy your item, Amazon just ships it straight to them. Amazon takes a cut of that. I think it's 20-30%. This section is incredibly high margin because Amazon just takes a cut, and they're essentially just storing it. They don't have to buy or sell anything, and they just take a cut because they have a distribution center. This portion of Amazon will continue to grow forever, basically, because as Amazon gets bigger, and we'll go to the economic moat in a second, but as Amazon gets bigger, this third-party sellers segment just continues to get stronger. Number 4, AWS. This, again, is a very lesser known portion of Amazon. If you didn't know, Amazon is the biggest IT provider on earth. And something to note, about a third of Amazon's valuation, depending on how you add it up, is AWS, because AWS has a revenue of about 80 billion. So if we put a price to sales of 5 on that, that would be 400 billion in market cap. Amazon's at like a 1.3 trillion. Yeah, 1.3 trillion market cap. So again, about a third of Amazon's valuation is probably AWS, and then it only accounts for 15% of the revenue. So something to know, as AWS continues to grow, that will definitely put upward pressure on the market cap. I cannot please, if you're going to get one thing out of this video, I cannot understate how important this is to Amazon's entire story. Amazon has incredible customer lock-in. What do I mean by that? And this isn't something I'm spinning out of thin air. You can simply go Google customer lock-in, AWS, whatever. Just please understand this one portion if you're going to be an Amazon investor. It says here, in economics, vendor lock-in, also called whatever, is a scenario where a customer becomes dependent on a vendor for products and services because they're not able to use another vendor without substantial switching costs. What does that mean? So, for example, Netflix is, I think, one of Amazon's biggest AWS customers. But what that basically means is every time you go on Netflix and you want to watch, I don't know, Avengers or something, right? And you click on Avengers, how does that actually like show up on your phone? It's cloud computing, right? So what that basically means is that, let's just say in the US, every time someone wants to go watch a movie, that needs to somehow like be on their phone, right? Like when you click on the movie and it shows up out of nowhere, that's Amazon being able to provide that. So the entire Netflix movie library is on Amazon's network. Now, the part where it gets really important is all that data and all those movies and all that, for that to be on Amazon's network, in order for Netflix to be like, you know what, screw Amazon, we're going to switch to Microsoft because Microsoft's cheaper. The switching costs is just so incredibly high that it would never make economic sense to ever switch off of Amazon once you're on Amazon's network. And another portion where customer lock-in becomes incredibly important is, for example, take Uber as an example. Uber, a few years ago, they're on the rise and they're like, you know what, US is pretty saturated. We're going to start expanding into New Zealand, okay? For Uber to expand into New Zealand and offer their application in New Zealand and their services in New Zealand, they need cloud computing. So that every time you open the Uber app in New Zealand, the riders need to be there, and all the stuff with the app needs to exist in New Zealand. How do they do that? It doesn't make sense for Uber to create their own IT infrastructure in the middle of nowhere in New Zealand, for example, right? And they create their own IT infrastructure to support their app. Meanwhile, they could, because that would cost too much, and then they don't necessarily know if Uber is going to stick in New Zealand, right? All these different risks. So what makes more sense is, hey, Amazon, give us a little bit of IT infrastructure with your pre-existing AWS, which we'll look at the map in a second here, but your pre-existing AWS infrastructure in New Zealand, and well, you know, we'll pay you a little bit, and then you let our app run in New Zealand, right? So companies that want to expand internationally, they're almost forced to go with a cloud computing option that already exists there because they don't necessarily know if their product is going to stick in that country. This is extremely important to Amazon's overall growth because once a company wants to expand into another country, they almost have to go with a cloud computing provider, so Amazon, Google, or Microsoft. And then once they're with whichever company they just chose, they almost have to stick with that company because the switching cost would be too high. And don't take my word for it. We can look at Oracle, for example. The reason why these like essentially dinosaur companies are continuing to grow a little bit and they continue to exist because these were the former IT providers of the world, Oracle and IBM, right? And they're growing at like 3% per year. The reason these companies continue to exist is because of the aforementioned switching costs. It literally doesn't make sense for RBC Bank, for example, to switch over from Oracle to Amazon because they have all this data and all this transaction history from the 1970s, the 1980s, whatever. And like how can you possibly switch all these lines of code of, oh yeah, this person came in at this time, they transacted this much money and they had this much in their balance, right? You literally cannot transfer all that data over. It just would not make sense. It would cost too much. This is where the switching costs come into effect. And this is the, where is it? And this is where the economic moat, which again, we'll cover in a second. Anyways, AWS, huge portion of Amazon. And Amazon started doing this thing about a decade ago where they started offering multi-year contracts to, again, get that lock-in of, okay, if a company's only there for like a year, maybe the switching costs, maybe they might switch over. But if you offer RBC again, a 5-year contract, a 3-year contract, and after 3 years, whatever, they're really integrated into the AWS system, they kind of have to stick with AWS. There is no other option. So that provides, again, another element of leverage to Amazon for them to negotiate with contract prices and all these different things. And again, just super strong portion of Amazon. And I already mentioned this, it doesn't make sense for companies to switch, it doesn't make sense for companies to make their own cloud platforms. Again, the example I gave with Uber in New Zealand. So yeah, companies that need to scale internationally, they kind of have to go with one of the cloud providers because they don't know, like Netflix, for example. Netflix doesn't know if in Eastern Europe, their product is going to stick. What if they go and they start losing incredible amounts of money and they made their own IT services in East Europe, right? So they don't know. Excuse me. This is a list of all the companies that use AWS. I'm not going to bore you through and read through all of them, but you can take a look. Those are all the companies. And then this is, I'll leave this in the description as well, but this is a map of where AWS has servers. So for example, like Bahrain, there's AWS servers there. In Africa, okay, none in Africa. Asia Pacific, this is every location of Amazon servers, right? So for example, if you have Netflix and Netflix wants to go and start like Netflix Spain, right? They want to expand into Spain. It really doesn't make sense for them to start using start making IT servers in Spain just for themselves. The cost would be drastically reduced if they were to just use Amazon stuff. And that's what they've historically done. Ads, portion number 5. If you didn't know, whenever you go on Amazon, there's this little word sponsored. What does that mean? So if you, for example, want to sell iPhone cases, you have a couple options, right? You can go to Google and you can put ads on YouTube. You can put ads on Google Ads. So when you pull up an article on the side, it says, here, you buy this iPhone case, whatever. Most people don't really look at that, right? Google kind of has to guess that if you want to buy an iPhone case and then place that ad there. Same thing with Facebook. If you go on Instagram, Facebook or Instagram or whatever, they kind of have to guess, oh, this person wants to buy this iPhone case. This person wants to buy this t-shirt or whatever. The part where Amazon's ad business becomes extremely strong is Amazon happens to have a text box where you literally type in iPhone 13 Pro Max case. So Amazon knows exactly what you want to buy, which means the top 4-5 searches, this becomes very valuable for you to become one of these 4 or 5 different searches here. It becomes extremely valuable. So Amazon's ad business, just to give you some figures, in 2022 did almost $38 billion in revenue, and this is a very high growth portion of Amazon, 21% year over year. This word right here, sponsored, combined with Twitch, of course, because Twitch does ads and stuff as well, but this word sponsored right here did more in revenue than Netflix, at 32 billion, and it did more in revenue than YouTube in its entirety at 29 billion. One Word, sponsored, did more in revenue than Netflix or YouTube. This portion of Amazon, again, very strong. It's like a shadow part of Amazon that nobody really knows. And again, I see this just gobbling up market share from Facebook and Google in the future because Amazon literally knows what you want to buy. That is extremely valuable to advertisers. Physical stores. This portion makes up about 5 billion of 500 billion. This is 1% of Amazon's revenue. Doesn't really matter. It's just Whole Foods and their little shops that they do in like big cities and stuff. I quite honestly don't really care about it. It's just going to tank on margins. I really don't care about this portion of Amazon. Finally, number 2, fundamentals. So I've spoken about the great things of Amazon the past, I don't know, however long it's been. But unfortunately, all of this comes at a cost. The fundamentals of Amazon are extremely poor. Amazon is free cash flow negative. Amazon's debt is continuing to grow. Meanwhile, Amazon's cash is continuing to diminish. Amazon's return on capital employed is negative. Amazon is diluting shares. Amazon is negatively profitable, and all around, everything that could possibly go wrong is going wrong. Oh, horrible margins, growing stock-based comp. Everything that could go wrong is going wrong with Amazon. They have, I forgot to mention this. They have a PE of 300. Fundamentals-wise, everything is bad about Amazon, but as one of the possible risk factors, and the reason why Amazon's fundamentals are just atrocious all around, is the capital expenditure. So if you note here, from 2019 to 2021, in the span of maybe 2 years, Amazon's capital expenditure more than quadrupled. This is because they just started ramping their fulfillment centers at like an incredible rate. So I won't say too much about it. I'll just let the CEO talk about it. But basically, all you need to know is and I'll link this in the description, but they started building out fulfillment centers just at an incredible rate. So here's the CEO talking about it.
Yeah, a lot has happened in the last few years that I'm not sure people anticipated. And if you just look in 2020, our retail business grew 39% year over year on a $245 billion annual run rate, which is unprecedented. And it forced us to make decisions in that time to spend a lot more money and to go much faster in building infrastructure than we ever imagined we would. We had built a physical fulfillment center footprint over 25 years that we doubled in 24 months. And we made...
So he just said that they had incredible demand during, COVID, which of course makes sense because during COVID, everybody's locked in. You can't really buy anything because all the stores and Walmarts and all that are closed, right? What do? Oh, okay, you just buy stuff from Amazon. So they had a lot of demand during COVID. And what he just said was they were forced to build out their infrastructure and their fulfillment centers. And he just said that it took them 25 years to build their fulfillment centers prior to COVID. And they doubled everything they'd built in 25 years in 2 years. That's what he just said. And then he continues on here, and he says something very interesting.
That decision, even though we knew we might be overbuilding because it took 2 years to build fulfillment centers at that time, and you had to it was hard for us to imagine what 21 was going to be, let alone 22, but we decided that we were going to shade on the side of consumers and sellers who didn't want to be constrained. And so that was a big decision that we made. And then, this time last year, it looked like we were coming out of the pandemic.
Anyways, he just continues on talking about COVID and all that other stuff. But basically, they just erred on the side of merchants and consumers, and they just wanted to make sure they had the infrastructure in place to possibly support this growing demand out of nowhere. There was a lot of uncertainty with COVID, and is this demand going to continue and all this stuff? So he literally says word for word that they decided to possibly overbuild on an infrastructure just to support the possibility of growing demand. Right? I'll link this interview in the description as well, but really good interview, clues you in on Amazon and what they're doing. It's from 7 months ago, but nonetheless, everything still holds up. Other risk factors, I just decided we can go through the 10K together here. Of course, The first risk to Amazon is business and industry risk. Intense competition. Again, they kind of have to say this just to not get regulated into the ground. 40% of US retail, online retail sales is Amazon. Intense competition, I don't know about that. Maybe in the future, they get a little bit competed away. That 40 dies down to 30%. But Amazon has such incredible brand value with online sales that everybody just knows, okay, well, I want to order this. I want to order a phone charger. I want to order whatever it is. You kind of just flock towards Amazon unless it's like specific things of like some of the makeup things, or you want to buy like Nike clothing. You can't really get that on Amazon, right? There's specific things that you can't get on Amazon that people have to order off of other online retailers. Our expansion into new products, services, technologies, whatever. This basically just means their R&D costs. So they don't know if their R&D, research and development, can yield them a return in the future. But something to note, their research and development has been the thing that has birthed AWS or Alexa or Kindle. All these innovative ideas that they've just brought out of thin air, it's been because of their expansion into new products and whatever, right? So sure, they put that as a risk, but I really see this as one of the strong points of Amazon, where out of thin air, they're able to just innovate and completely blue ocean strategy, new stuff, right? They just kind of create things out of nowhere. International operations expose us to a number of risks. This is a very real risk to Amazon. If Amazon starts doing business in Bahrain, for example, they don't know the political conditions there, and the government of Bahrain may start giving them shit, and it's just they list off the specific things that could possibly go wrong. But there's a lot of risks to companies that operate internationally. This is one of the reasons why I've held off on, for example, like Estee Lauder or something, because they sell so much of their stuff across Asia. And like I think they mentioned China specifically here. There's so much regulation risk that comes from India or China or Russia or just all these different countries, and that they're not very familiar with it exposes them to geopolitical risk, essentially, if they expand out internationally. Same thing that's happened to Starbucks or Estee Lauder or all these other companies, right? Variability of retail business, increase strain on our operations. So this is what we've seen in 2022. As the economy kind of dies down and interest rates go up and whatever, the consumer becomes more concerned with, I think the CEO actually mentions it, they're trying to, the exact words he used, they're trying to stretch their dollar. So as the economy dies down, people are way more wary of spending money. And this is something that can largely impact Amazon, because Amazon's main business, the e-commerce, is essentially retail, right? So retail by design is kind of a bad industry to be in, because if you go into an economic slump, then that negatively impacts the sales of that company. Fraudulent or unlawful activities of sellers, something relatively small, but this has been a concern with Amazon, where they have so many third-party sellers that they simply cannot keep up with, okay, is this person selling something illegal? Oh, okay, the flashlights that blind people, or this knife, there's supposed to be regulation to it. Whatever. There's so many products on Amazon, you can't possibly keep track of everything, and making sure that in every, again, going back to the international thing, what if those flashlights are banned in a state in America? Or what if they're banned in Bahrain? Or what if they're banned in a certain part of the world? You just simply can't keep track of all those things because Amazon's too large. This is a possible point of contention with Amazon. We face risk related to adequately protecting our intellectual property, being accused of infringing intellectual property rights of third parties. I don't really understand this one. We are not always able to discover or determine the extent of any unauthorized use of our proprietary rights actions. I think something to do with third party. I don't know. I don't really care about that one. Foreign exchange risk. This is absolutely huge. You can see this happen actually with the last year when the dollar was much stronger than other currencies around the world. You would see net sales grew 11% year over year, 7% because of currency exchange rates and all that. Our expansion places a significant strain on our management, operation, financial. This goes back to the growing infrastructure, right? So as they continue to grow their infrastructure in their fulfillment centers, this causes for a slump in their net income, their free cash flow, all that. We experience significant fluctuations in our operation resulting growth rate. Again, this goes back to the whole retail thing of as we go into a recession or as the economy dwindles down, this could negatively impact Amazon. So all in all, I get the idea that Amazon is they are in the consumer cyclical sector. Jesus. So yeah, there's a lot of things that can materially impact Amazon, but nothing that can like long-term compete away Amazon by the look of it, right? Of course, if like Walmart gets into e-commerce and they just get much bigger than Amazon, offer better prices, that could definitely cause for some things to go wrong. But other than that, it doesn't really seem too bad. They keep going on inventories and this and that. Like obviously Amazon, they deal with a lot of distributions and they have to like move things across the globe and all that, right? So there could be inefficiencies with that, but other than that, doesn't seem too bad to me. Of course, there is a lot of risk to Amazon, but it's just something that's priced in. The economic moat of the company. Jesus. So Amazon, as I mentioned earlier, and feel free to read this, I don't feel like reading it, but Amazon essentially, they just innovate over and over and over again. If we go back to the research and development over here, you can see a great deal of Amazon's expenses is their research and development. They dump a lot of money into research and development. And this is how they came up with AWS. This is how they came up with Kindle, Alexa, all those things, right? There's an element of the flywheel effect, which I explained earlier. Amazon has cheap prices. More customers come to Amazon. More customers causes for cheaper prices. And it just continues from there. Amazon is already entrenched into the world. So if, for example, we saw this happen with Peloton, right? Where if you go on Amazon and type in exercise bike, you're going to get a bunch of random exercise bikes from China or whatever, right? And Peloton realized, hey, there's huge demand for exercise bikes, but because we're not on Amazon, we're selling significantly less units than if we were to sell on Amazon. Sure, Amazon's going to take a 20-30% cut on that, but that 20-30% cut accounts for the huge sales growth that we're going to see on the flip side of that. So there is this element of Amazon, like their brand already existing, that like when someone's going to look for example, exercise bikes, they're not going to go look on Peloton's website. They're going to go search on Amazon, right? And that's a part where it's like really huge for Amazon because as Amazon continues to grow, more brands like Peloton or, for example, the security like Eero and what's the vacuum that like whatever, they're buying this vacuum brand as well, right? But as Amazon continues to grow, more brands need to be on Amazon in order to get sales, despite the 20-30% cut that Amazon's going to be taking. Network effect. So this goes back to the Peloton example, but as Amazon becomes bigger, brands need to flock towards Amazon in order to continue selling, and there's this like network effect of more people using Amazon causes Amazon to become a stronger brand in the world. This is a study, not a study. I don't know if this is a study by Morningstar or whatever, but anyways, this is from Morningstar. But they basically cover how they have 1,500 stocks or companies, and they rank them as wide moat, narrow moat, or no moat companies. And then you can see the annualized returns, mean or median. And basically, if you look down the list, a lot of these things that they consider as wide moat companies, that like qualities of a wide moat company, for example, the switching cost that we mentioned with AWS, this contributes to long-term value creation for Amazon, or the network effect I just mentioned, or the intangible assets. So for example, the brand value of Amazon, or their distribution network counts towards this intangible assets. This is something very huge for Amazon, where just because they already exist, you kind of have to start selling on Amazon. Peloton, sure, they're selling on their own platform as well, but just because Amazon exists, if they were to sell on Amazon, then they can tap into that distribution network. This is something that Pepsi and Coca-Cola and stuff also have, but this would count towards their intangible asset. Cost advantage. Amazon is simply cheaper than other retailers. For example, a couple years ago, I was looking to buy headphones, and I went to Best Buy, and it was like $400 something for my Sony headphones. And then I just simply looked on Amazon, and it was like 300 something. So, and Costco also does this, where Costco is significantly cheaper than other options. And that, like Amazon and Costco and stuff, they're able to bring costs down because they make it up in other segments of their business. So the cost advantage, like, it's just a no-brainer to the consumer to flock towards Amazon because of these things. Efficient scale, I don't know about that one. Maybe a portion of the AWS or their third-party sellers, but I don't know. Nonetheless, it's one of the weaker economic moats, and it doesn't really matter too much. And I have some stuff written here. Feel free to read. Entry points, finally. Basically, this is the Fibonacci retracement here. And of course, if you like draw this differently, the 0.38 and the 0.61 Fibonacci retracement, they're basically identical because you could just flip it. And Amazon, honestly, if your time horizon is 5, 7, 10 years, you could just kind of buy in and just forget about it. But if you were to try to be a little bit more meticulous with the timing, you can see this blue trend line I've drawn here, and maybe around the 122-ish level, that would be an area where you could possibly try to buy in. Moreover, you can see the 200-day moving average in red and the 50-day moving average in green. There has been the golden cross, so there's bullish momentum into the stock. But I don't know, as this green moving average starts to rise, it will probably be in that area as well. On the volume profile, you could also kind of see the same story being told, where this 122 to 130-ish level, this is the area of high volume you'd probably want to try to buy in. Lower than that, maybe the mid-teens all the way down. There's a gap here. Like, realistically, the low 120 seems to be an area where it would be an opportunity to buy. If I just simply adjust the volume profile to the previous 200 candles, you can also see this one, like the high 120s to the low, the low teens. So this area is just high volume in general. Again, somewhere in here you can start buying. There's a YouTube channel called the Investor Channel, I want to say, and he always gives the example of if you want to buy 10 shares, maybe start buying a couple up here, and then if it were to go down, you would start to buy a few more, and then by the time it gets into the mid-teens, if it were to pull down that much, then you've got your entire position. With that being said, thank you for watching. I will be posting more of these deep dive type videos in the future, so if you're interested in that, please go ahead and subscribe. Thank you for watching.